Welcome to the Deep Dive, the only place where we really break down the complex strategies of top investors into, well, actionable knowledge for you. Today, we're digging into something fundamental, really fundamental in real estate success. It's that core truth. Profit, real profit, it's made when you buy, not when you sell.
Absolutely. That principle, it's non-negotiable. If you're serious about building wealth through property, you absolutely have to develop this, let's call it a specialized skill set. The skill to consistently buy assets for less than they're actually worth in the market.
Right, and that's our mission today. We want to give you, our listener, the playbook, the mindset of a professional deal finder, like a real estate treasure hunter. We're aiming to shift your focus away from, just competing with everyone else on the MLS for those obvious, often overpriced listings, and get you into that hidden world where you actually create your own unique profit opportunities.
And we've got quite a stack of material here to guide us. Sources covering everything from high-volume investment strategies like the big players use, all the way through essential shortcuts for financial calculations, and even digging into the psychology behind negotiating with motivated sellers. We're basically going to unpack the systems the pros use, finding those properties that, frankly, most people just miss.
Okay, let's jump right in. The mindset. It seems like this is the big differentiator, doesn't it? The thing that separates the real winners from those who just kind of dabble. What's the real operational difference between an amateur looking at maybe a few houses a year and a professional who's truly building wealth this way?
Well, it really boils down to perspective.
Hmm.
You have to see acquiring property not as like a casual shopping trip, but more like a specialized high-volume manufacturing process. The amateur often lacks systems. They rely too much on hope, maybe a bit of luck. The professional, they operate through consistency, persistence, and just sheer volume. It's a numbers game.
The numbers you mentioned from the sources are, well, they're pretty eye-opening. They really highlight that difference. There's that example of the investor post-financial crisis, right? Buying over 100 foreclosed homes a year at deep discounts. How is that scale even achievable for most people?
It's the system. It has to be relentless. To close, say, 100 deals a year, you just can't rely on one channel or, sporadic effort. It won't cut it. That professional team, they had to systematize their lead generation to an incredible degree. We're talking looking at nearly 1,000 potential houses every single week,
Yeah.
filtering those down, and then actively putting in offers on dozens of properties weekly. That kind of volume, it just dramatically increases the odds mathematically of finding those few deals priced way below market.
Okay, 1,000 houses a week. That's obviously not something one person can do manually without serious automation or a team. So for the everyday investor listening, what does that system look like in practice? How do they avoid just striking out constantly?
The professional investor, they set up filters. They use objective data sources, things like public records, lists of code violations, tax default data. It's not about browsing pretty pictures online. They establish really strict buying criteria upfront. Location, minimum discount needed, the cash flow metrics that have to be hit, period. If a property doesn't instantly meet those system criteria, it's discarded. Move on. The amateur, they might look at one property and think, maybe I can make these numbers work. The professional process is hundreds of leads until a property basically forces itself into the yes pile because the numbers are undeniable. That casual investor, just looking at one place a month, hoping to strike oil, honestly, they'll probably just run out of steam, run out of willpower, long before they find a genuinely good deal.
That brings us straight to maybe the biggest hurdle. Emotion. The sources are crystal clear on this. Letting emotional decisions creep into the business side. That's a fast track to losing money. Can you give an example? Like, what specific business rules get broken when investors let emotion take over?
Oh, definitely. Experienced investors, you hear this again and again, they'll tell you almost every significant loss they took. It traces back to breaking a fundamental business rule, usually because of desperation, or maybe wishful thinking. For instance, a core rule might be, never close without a clean inspection and title report. No exceptions. But then an emotional decision kicks in. Maybe inventory's tight, they feel pressure, there's a deadline, and they say, the title company promised they'd clear up that tiny lien after closing. It's such a good deal, I can't pass it up now.
And that feeling, that FOMO, the fear of missing out, it just overrides the system they supposedly set up.
Exactly, and that's the difference between real commitment and just, well, casual interest. If you want serious success, you've got to put 100% effort, intellectual and financial, into investing. The sources really hammer this home. If you treat real estate like a sideline, like a hobby, it's going to pay you like a hobby, which often means minimal returns or even losses. Financial independence, it demands that kind of do-or-die commitment to your system.
Okay, so let's assume we've got that commitment. We're unemotional, systematic. The core investment philosophy then becomes this buy right mantra. What does running tomorrow's numbers today actually mean in practice?
It's all about anticipatory diligence. Think ahead. The rule of thumb has to be, if this property isn't worth selling to a really sharp, astute buyer down the road, then it's definitely not worth buying today. You have to look at your income and expense projections through the most critical lens possible. Imagine the smartest investor you know buying it from you in 5 years. If your current assumptions may be about rent growth, or utility costs, if they're flimsy, that future smart buyer, they'll poke holes in them during their due diligence, and that forces you to drop your price later. You lock in your profit by making the deal bulletproof right from day one. Buy it right.
And if you buy right, you set yourself up for what the sources call the real estate triple play. That sounds like the ultimate goal.
It really is. The triple play, it means you're pulling three major levers for wealth creation all at once. First, there's appreciation, market value growth, though honestly, you should never bank solely on that. Second, debt paydown. This is huge. Your renters are paying down your mortgage principal month after month. That builds your equity automatically. And third, positive cash flow. That's the money left in your pocket after all expenses are paid. Pure passive income. A truly great deal. It delivers big time on all three.
Okay, let's shift gears a bit from the hard numbers to the softer skills. Negotiation. The sources mention this law of stratospheric success, emphasizing giving more value than you take. How does that apply when you're actively trying to buy below market value? Seems contradictory.
Yeah, it can sound that way initially, but it's about the difference between being predatory and being a problem solver. The law says your true worth is determined by how much more value you give than you receive in payment. So when you're dealing with a motivated seller, someone facing foreclosure, maybe a death in the family, divorce, some kind of financial distress, often, their biggest need isn't the absolute highest price. What they desperately need is a solution, delivered with speed and certainty.
So the value you're giving isn't necessarily just the cash amount, it's the relief, the end to their stress.
Precisely. You offer speed.
Yeah.
Certainty of clearing, the ability to navigate a complex legal or financial mess for them. Think about it. If a seller is about to lose their house at auction next week, offering a fast, guaranteed cash close that saves their credit and maybe puts a little bit of equity cash in their pocket, that's immense value to them, even if the price is technically below full market. You've used soft power, understanding their need, to acquire hard asset advantageously.
And we shouldn't overlook basic human psychology here either. The power of liking and similarity in getting people to agree, to comply.
Oh, it's subtle, but incredibly powerful. People are just far more likely to negotiate favorably or agree to things with people they genuinely like. And we tend to like people who seem similar to us. This could be as simple as, dressing appropriately for the neighborhood you're in, or sharing a small, relatable personal detail, even just validating their difficult situation. If you come across as aggressive, overly formal, like a corporate shark to someone in distress, they'll likely shut down. But if you seem sympathetic, professional, yet approachable, maybe even familiar, like someone who understands their situation, compliance and the willingness to make a deal goes way up. It's about building that rapport to secure a deal that maybe money alone couldn't have bought.
Okay, we've got the mindset, the system dialed in. Now, where do we actually point this systematic investigative energy? The sources seem to overwhelmingly target distress, specifically foreclosure in that pre-foreclosure window. Why is the auction itself often maybe less efficient than catching it beforehand?
Well, foreclosure sales, the auctions themselves, they're almost inherently designed to sell property for less than true market value. Think about what defines a market value transaction legally. It needs open exposure to the market, knowledgeable buyers acting without undue pressure, an arm's length negotiation, an auction. It fails on pretty much all those points. It's a forced sale. It's time crunched. So yes, savvy bidders who've done their homework can definitely capitalize on that inefficiency.
But the risk of bidding blind at auction seems huge, right? You often can't even get inside to inspect, and you could inherit massive liens you didn't know about.
Exactly. Which is why the homework part is absolutely non-negotiable. Bidding blind isn't investing. It's pure speculation. Gambling, really. You have to thoroughly investigate beforehand. Drive by, check public records for liens, pull title reports if possible, estimate repair costs, then set a firm maximum bid based on those facts. But the real sweet spot, where you can potentially offer the most value to the seller while also maximizing your own potential profit, that's usually in the pre-foreclosure period.
Define that pre-foreclosure window for us, and why is there such urgency around it?
So the pre-foreclosure period, it's that specific time frame. It varies by state, but often it's between, say, 30 and 120 days where the homeowner is officially in default. They've missed payments. But crucially, the lender hasn't yet completed the final legal steps to actually seize the property. Once that final foreclosure action happens, your chance to deal directly with the owner, it's pretty much gone. This window is critical for investors because the owner is often highly motivated. They want to avoid the huge credit hit, the public embarrassment of a full foreclosure stamping their record.
And when you approach these owners, you mentioned that the strategy isn't to be a vulture, but more like an aid. How do you start that very sensitive conversation? You mentioned using specific feeler questions.
Right. The approach has to be about offering a clear path out of their distress. You're selling the win-win outcome. For the owners, they get some cash for whatever equity they have left. They get to move on. And, importantly, depending on how you structure the deal, their credit might be salvaged, which is huge for them. Meanwhile, the investor gets the title, usually quickly.
So before you even talk price, you're kind of probing their flexibility and real motivation level.
Exactly. These feeler questions, they're designed to open up creative possibilities. Before you jump to a formal offer, especially a lowball cash one, you might float an idea like, just curious, have you given any thought at all to maybe offering some financing with the property? Something like that. It's crucial because if they're open to seller financing, suddenly you might be able to acquire the property without needing a bank loan immediately. That drastically improves your return on equity, your cash-on-cash return. It reveals if they need a lump sum now or if they have some flexibility.
Okay, moving beyond purely financial distress, the other major route to finding or maybe creating value is the fixer-upper, often using that BRRRR method. Explain how fixing up a property fundamentally supercharges the cash flow.
BRRR. Buy, rehab, rent, refinance, repeat. The beauty of this strategy is it lets you basically reset the property's value clock. You buy a property for way less than market comps because it needs work, right? So your initial purchase price, your basis, is low. Then you invest capital, the rehab part, to bring it up to standard, increase its functional and aesthetic value. Now, when you go to refinance the second art, the bank appraises it based on its new, improved market value.
Right, and since that refinance loan is based on the higher appraised value, your loan-to-value looks good to the bank, but your actual debt, compared to what the property is now worth and can rent for, is relatively low.
Precisely. You've essentially replaced your initial, often short-term or expensive funding, like hard money or maybe private money, with a long-term, usually lower-interest conventional mortgage. And that new mortgage payment is significantly cheaper relative to the higher market rent you can now command because the property is fixed up. That gap, higher rent versus lower relative mortgage payment, that's what supercharges your monthly cash flow.
Let's use that anecdote from the sources to make it concrete. Walk us through that $29,000 house example.
Okay, yeah, great example. So the investor buys this distressed house through a wholesaler for just $29,000. They figure, okay, it needs about $12,000 in rehab to make it rentable and desirable. So their total capital invested is $41,000, $29K plus $12K. Now here's the magic moment. After the rehab, the bank appraisal comes back at $70,000. Because banks will often lend up to, say, 80% of the appraised value on a refinance, they were able to get a new loan for 80% of $70,000, which is $56,000.
Wait a minute. They put in $41,000, but they borrowed $56,000 back out. So they got all their initial cash back plus an extra $15,000.
Bingo. That's the repeat engine kicking in. They pulled out all their original capital and tax-free profit, which they can now use to go buy the next undervalued deal. And what are they left with? Performing rental property, generating rent based on a $70,000 market value, but they're only paying a mortgage based on that $56,000 loan. Highly profitable.
But creating value doesn't always mean swinging a hammer, right? You mentioned repositioning an asset. What does that look like without major renovations?
Right. Repositioning is about adding value through smarter strategy, better management, or maybe resegmenting the target tenant, not necessarily physical construction. Take that example of the 73-unit apartment complex. It was valued around $7.5 million. Decent condition, but rents were just okay, maybe $750 a month. Most investors looked at it and passed. Why? Because there wasn't an obvious fixer-upper angle. No peeling paint or broken windows to discount. The opportunity was hidden. It wasn't physical decay.
So where was the hidden value then, if it wasn't deferred maintenance?
It was in the management and the market positioning. It was undermanaged, and the rents were below what the market could truly bear with better operations. A savvy investor could see that by just bringing in professional management, maybe implementing utility billbacks, RUBS, or adding some small desirable amenities like a little dog park or secure package lockers, they could probably justify raising rents by $100, maybe $150 per unit over time. Now, that might sound small per unit, but across 73 units, it dramatically increases the net operating income, the NOI. And since commercial properties are primarily valued based on their NOI, that increase in income translates directly into a significant jump in the property's overall valuation, all without needing a major renovation budget.
Okay, let's tie this back to negotiation, especially when timing is everything and the seller is maybe a distressed institution like a bank needing to offload a property.
Yes, this is where timing, that quick analysis we talked about, and frankly, a bit of audacity come together. That case study with the motivated lender is perfect. Remember, the property initially had this high predicted appraisal, like $550,000. But the buyer's broker was smart. They didn't share that rosy prediction with the lender just yet.
And then the actual appraisal came in much lower, $350,000, because of those environmental issues, the musty basement smell, right?
Exactly. And that lower appraisal, that was the trigger. It created a massive opportunity because it suddenly gave the bank justification to accept a much lower price. The buyer knew the foreclosure clock was ticking for the bank. They knew the bank's priority was likely certainty and speed, getting it off their books, more than squeezing every last dollar. So the buyer came in with an extremely aggressive offer, $220,000.
Wow, that's a serious lowball from 350K, let alone 550K. What makes that kind of offer work in a distressed situation when it would just get laughed at in a normal market?
Because you're dealing with an institution, the bank. They often have ongoing holding costs, legal fees, maintenance, property taxes, the cost of capital tied up. The longer they hold it, the more it costs them. That aggressive $220,000 offer, it forced a quick decision. Now, they didn't accept $220K, but it immediately reset the negotiation floor way down. They countered and eventually settled at $250,000. The key takeaway: the buyer did a quick analysis, knew it was worth pursuing even with issues, understood the seller's motivation, the ticking clock, and used that leverage to act boldly and snag a huge discount.
Okay, that need for quick analysis seems absolutely critical. If you're potentially looking at hundreds or even thousands of properties, you can't build a detailed spreadsheet for every single one on the first pass. We need efficient filters. Let's start with this 50% rule.
Absolutely. The 50% rule is like your first line of defense, your initial gut check. It's a rapid assessment tool designed purely to see if a property is even worth spending more than 5 minutes on. It is not an accurate financial model. Let me repeat that. It's a screening tool, nothing more.
Got it. So walk us through how it works, and importantly, what does it leave out?
It's super simple. The rule just makes a rough assumption that about half, 50% of your gross scheduled income, GSI, which is the total potential rent if every unit is occupied all year, about half of that GSI will get eaten up by operating expenses. Now, the big exclusions. This rule explicitly leaves out your debt service, the mortgage payment, principal and interest. And it often doesn't adequately account for big-ticket capital expenditures or CapEx, things like replacing a roof, a new HVAC system, stuff that doesn't happen every year but costs a lot when it does.
Okay, let's run an example. Say we're looking at a small property, maybe a duplex, and the total potential rent is $4,500 per month.
Okay, $4,100 GSI a month. The 50% rule immediately estimates that $2,250, half of $4,500, will go towards operating expenses. That's your property taxes, insurance, maybe some utilities, routine maintenance, vacancy allowance, property management fees, etc. So you're left with approximately $2,250. That's your rough estimate for net operating income, or NOI. Now, if you have a ballpark idea of what your mortgage payment might be, let's say it's $1,800 a month, you subtract that from the $2,250 NOI. That leaves you with an estimated monthly cash flow of $450. Okay, so if that $450 looks potentially interesting, then you decide to dig deeper, spend more time on due diligence. But if that calculation instantly shows negative cash flow, you just toss the lead and move to the next one. Exactly. It's a quick kill switch for bad leads. But, and this is a huge but, the rule is extremely sensitive to local conditions. It's a very rough estimate. If you're in an area with super high property taxes, that 50% could easily be 60%. Or if the building has master metered utilities and water costs are sky high, your expenses could be way more than 50%. It gives you a signal, a starting point, but you always have to verify the actual local expenses later if the deal passes the initial sniff test.
Okay, so if a property gets past the 50% rule filter, the next critical metric people talk about constantly is the cap rate, or capitalization rate. We need to understand this better, especially why the common wisdom of higher is always better can be really misleading.
Ah, the cap rate, yes. So technically, it's the property's net operating income, NOI, divided by its purchase price or current market value.
Mm.
Conceptually, you can think of it as the rate of return you'd get if you bought the property all cash with no mortgage. The reason higher is better is often misleading is because the cap rate is just a snapshot. It reflects present performance. And great investors, they buy based on future potential.
How do you factor in that future potential when you're looking at a cap rate number today?
You absolutely have to look at the bigger picture, the macro context. Let's compare two hypothetical properties. Property A is selling at what looks like a juicy 8% cap rate, but it's located in a town that's losing population, has weak job growth, maybe aging infrastructure, stagnant or declining market. Property B is selling at a more modest 6% cap rate, but it's in a growing secondary city. Think strong population growth, maybe a big new employer moving in, rising income potential. And let's say, this 6% cap property is currently underperforming because of lazy management.
Okay, yeah, the amateur instinct might be to jump at the 8% immediately. Why could that 6% deal actually be the much better long-term investment?
Because with a 6% deal, you're essentially paying a bit of a premium. The lower cap rate reflects a higher price relative to current income, specifically for that growth potential and for the opportunity to fix the underperformance. In Property B's growing market, you likely have strong potential to increase rents significantly, maybe 20% over a couple of years, with just some minor improvements and better management. That rent growth dramatically boosts your NOI. And in commercial real estate, increasing the NOI directly forces the property's value upwards. You create appreciation. Meanwhile, that 8% property in the stagnant town, rents might stay flat or even decline. You get a decent yield today, maybe, but potentially zero long-term capital growth. The superior deal is often the one where you can force the future value up, even if today's cap rate looks less impressive on the surface.
That definitely requires digging much deeper once you decide a deal is worth pursuing. When you get to the actual income statements, what are the absolute key verification steps during due diligence?
Verification is everything. Assume nothing. Verify everything. First, gross potential rent, GPR. Does the seller's claimed GPR actually match the unit mix and realistic market rents? If they say 5 two-bedroom units should rent for $1,200 each, you need to pull current third-party comparable rental data for that specific neighborhood to confirm if $1,200 is reality or just wishful thinking. Don't trust their rent roll blindly. Second, scrutinize every assumption about future growth. If the pro forma shows 5% annual rent growth, where's the proof? Is it backed by solid, local market data, recent rent surveys, economic reports, or is it just generic optimism? Challenge those assumptions.
And especially for those value-add deals, you mentioned the vacancy factor needs careful modeling. It's not just a simple percentage.
Absolutely critical. You have to go way beyond plugging in a generic 5% or 7% economic vacancy factor. For a value-add play, you need to realistically model the physical vacancy required during renovations. Let's say you have a 20-unit building, and your plan is to renovate 3 units at a time, and each renovation takes 4 months. Well, that's 12 unit months of zero rent you have to account for spread across those units. You also need to model the phasing of the rent increases. You can't just assume all units hit the higher rent on day one post-renovation. It takes time to lease them up at the new rate. Ignoring this detailed vacancy and lease-up modeling, that leads to painful cash flow shortfalls during your hold period.
We've talked about needing capital. Since we're hunting for these undervalued deals, often the ideal is no money down, which, as you clarified, really means using other people's money or OPM. Creative financing seems essential here.
Oh, it's the lifeblood of acquiring deals aggressively, especially when you're starting out or scaling fast. Seller financing is just a fantastic tool. It lets you bypass the banks, which means faster closing, potentially more flexible terms. However, there's a huge caveat you have to watch out for. Don't overpay for the privilege. Many sellers, understandably, want a premium, a higher purchase price, in exchange for the risk and hassle of carrying the note themselves. Smart investors need to resist paying that premium. Your benefit is avoiding bank fees and hoops. That shouldn't translate into paying more for the actual asset. Negotiate hard on price, even with seller financing.
What about using hard money lenders, especially for someone using the BRRR strategy who needs short-term cash for the purchase and rehab before refinancing? It seems inherently risky due to the high costs and short terms.
Hard money definitely has its place. It's excellent for speed and flexibility on the front end, acquiring the property and funding the rehab quickly, especially for deals banks wouldn't touch initially. But you're absolutely right. Using hard money with the intention of holding the property long-term as a rental. That's playing with fire if you don't have solid exit plans. The costs are high. You're often paying upfront points, maybe 2 to 5% of the loan amount just to get the loan. And the interest rates, significantly higher than banks think 9%, 12%, even 15% sometimes. And the crucial part, the loan terms are short, usually 6 months, maybe 12, 18 if you're lucky. That clock is ticking loudly from day one.
So if that planned refinance hits a snag, maybe the appraisal comes in lower than expected, or interest rates spike, making the bank loan unworkable, the investor is suddenly in a really tight spot.
Catastrophic trouble, potentially. That's why, before you even sign that hard money loan agreement, you absolutely must have multiple exit strategies clearly mapped out. And I mean viable strategies. Plan A is the refinance. Okay, what's plan B if that fails? Do you have a minimum acceptable selling price calculated that gets you out from under the hard money debt, even if it means minimal profit or breaking even? What's plan C? Do you have a potential partner lined up, someone with strong credit who could step in and be added to the deal to help secure the refinancing if your own profile isn't enough? Without those concrete backup plans, hard money isn't leverage, it's a massive liability waiting to explode.
It sounds like all the financial wizardry in the world doesn't matter much if you don't have a steady stream of potential deals coming across your desk. It almost sounds like successful real estate investing is less about the investing part and more about being in the lead generation business first.
That is precisely the mental shift required. If you want professional level results, you have to adopt the mindset that you are first and foremost in the lead generation business. Your key performance indicators, your core business metrics, aren't just rent collected and expenses paid. They are leads generated and offers made. It's a funnel. The simple, brutal truth is, no leads means no deals means no sales. Doesn't matter how brilliant you are at analyzing or negotiating if you have nothing to analyze or negotiate on.
So how do the pros ensure that constant flow? How do they move beyond just, hoping their real estate agent occasionally sends them something interesting that isn't already picked over?
It's about systematic, multi-channel outreach. Consistently. We're talking about actively generating lists from public records looking at probate court filings, county records for code violations, tax delinquency lists, things that indicate potential motivation, and then implementing targeted, persistent direct mail campaigns to those lists. It means literally driving for dollars, systematically driving neighborhoods looking for visual cues of neglect. Overgrown lawns, boarded windows, overflowing mailboxes, signs of distress or vacancy. It definitely requires building a strong network of wholesalers, bird dogs, other investors who might bring you deals before they hit the open market. The core idea is building a machine that constantly feeds you opportunities, rather than relying on summoning heroic bursts of willpower once a month to go find a deal.
Okay, so the machine generates the leads, but the sources really emphasize that mastering the follow-up is just as critical. That sounds, tedious. Why is persistent follow-up so incredibly important?
Because timing is everything. The very first time a potentially motivated seller gets your postcard or your call, odds are they're not quite ready to sell yet. They might still be in denial, emotionally resistant. Maybe the legal paperwork isn't finalized. Good follow-up, it's really an art form. It takes practice, it takes grace, and it takes diligence, often over several months. It's the discipline of checking back in maybe every few weeks, not being pushy, but gently reminding them that you exist as a potential solution provider when they are ready. The data shows overwhelmingly that most off-market deals are not closed on the first contact. They happen on the 5th, 6th, maybe even the 10th follow-up touchpoint. Persistence pays off hugely here.
That seems directly related to that professional concept you mentioned earlier, the more balls-up approach. You can't get emotionally attached to any single lead.
Exactly. The most successful investors, they're always moving forward, always cultivating the next deal. They never, ever allow themselves to become reliant on one single sale closing or one client saying yes. What this does is it builds resilience. When a deal inevitably falls through, maybe the contract gets canceled last minute, maybe that appraisal does come in unexpectedly low, they don't suffer that crushing emotional blow that completely derails the amateur investor. They just shrug, maybe sigh once, and immediately pivot their focus to the next ball they already have spinning in the air.
Yeah.
They never close a successful deal and then sit there wondering, okay, what now? Because their pipeline is constantly refilling itself with new opportunities.
And for investors who rely heavily on OPM, other people's money, or partnerships, building a strong personal brand seems like it becomes a crucial asset in itself.
Oh, absolutely. Here's a cold, hard truth in this business. People do not lend significant amounts of capital to people they do not trust. Full stop. Your personal brand, how you present yourself, your reputation, often built digitally now but reinforced in person. That is your currency when raising money. It has to be built on a foundation of verifiable experience, demonstrating deep knowledge, and maintaining a consistently professional presentation. You need to actively work to be known as someone who is, frankly, wicked smart with real estate. Someone who understands the nuances between a 6% and 8% cap rate, who grasps the risks of hard money, who speaks intelligently about market trends. That strong brand is what convinces potential partners or private lenders to trust you with their money, maybe even choosing your 6% cap deal over someone else's seemingly better 8% deal because they trust your execution.
Let's look ahead a bit. The future of finding these deals. Leveraging technology and data. The sources suggest real estate is still kind of lagging technologically, making it ripe for prop tech innovation.
Absolutely. There's a reason billions are pouring into real estate technology right now. Many core processes are still incredibly archaic, manual, and inefficient compared to other industries. For investors, this presents a huge opportunity. Leveraging automated data collection, using AI-driven tools for market analysis, this can give you insights that go way beyond simple square footage comparisons or looking at Zillow estimates.
Can you give some specific examples? How does an individual investor actually use AI or data APIs to get an edge today?
Well, by linking various database APIs, some public, some proprietary, some purchased through specialized data providers, you can start to uncover patterns that most people miss. For instance, using systems to automatically track local government infrastructure spending, where are new roads, schools, parks being planned or built. That gives you foresight into areas likely to see near-term appreciation. That's a leading indicator. Or tracking zoning change applications and approvals. If an area is rezoned to allow for higher density development, or changes from, say, industrial to mixed use, that creates immediate value add potential through repositioning, completely unrelated to the current state of the buildings there.
You also mentioned pulling in non-traditional data sources, things like FBI crime stats or even EPA climate change data. Why would a real estate investor need that level of granular, almost obscure detail, especially when looking outside major metro areas like in second-tier cities?
Because traditional real estate data might make two different second-tier cities look remarkably similar on paper. Maybe they have similar population growth rates, similar average home prices, similar credit scores. They look interchangeable. But when you layer in specialized data, it can reveal hidden risks or opportunities. For example, overlaying EPA projections for future flood zone changes or vulnerability to extreme weather events. One city might face massive increases in flood insurance premiums or rebuilding costs down the road, while the other is relatively safe. That drastically changes the long-term risk profile. Or analyzing detailed FBI crime data, not just citywide stats, but drilling down to neighborhood heat maps. You might discover that a neighborhood perceived as safe based on old reputations is actually experiencing a rapid recent spike in certain types of crime that hasn't hit the mainstream awareness yet. This kind of proprietary intelligence, often derived from combining multiple data sources, allows you to avoid potential future liabilities and really focus your acquisition efforts on assets that are truly resilient and genuinely undervalued based on factors others aren't even looking at. It helps the modern treasure hunter differentiate fool's gold from the real thing. Hashtag outro.
Wow, this has been an incredibly detailed deep dive. We've really unpacked the systems, the mindset, everything required to effectively find undervalued property. It feels like listeners now have a solid professional toolkit.
Yeah, I think we covered the key pillars. Adopting that essential professional mindset, focusing on persistence, systems, and keeping emotion out of decisions. We pinpointed where to look, targeting motivated sellers, especially in that pre-foreclosure sweet spot, and also how to manufacture equity through smart strategies like BRRRR. And critically, we broke down how to master that quick financial analysis using the 50% rule as that initial rough filter, but then moving to a much more nuanced understanding of cap rates, prioritizing future growth potential over just the current yield.
It really is a systematic approach designed to shift you away from competing head-on with retail buyers for listed properties and instead empowering you to create your own profitable opportunities using leverage, knowledge, and foresight.
And remember, we talked about how the pros thrive by generating and sifting through thousands of potential properties just to find those dozens of viable deals. So maybe a final thought for you to chew on. How can you leverage something like the law of behavior change? That principle James Clear talks about making desired habits simple, easy, obvious, and satisfying by removing friction. How can you apply that to structure your own weekly routine so that the process of generating and filtering leads for undervalued properties becomes less reliant on heroic willpower and more of an automatic low-effort system? Maybe it's dedicating specific time blocks, using certain software, automating outreach. If you can make the process itself easier, almost effortless through systems, that continuous practice becomes sustainable. And that consistent, almost automatic practice, that's the real secret key to building and maintaining a pipeline brimming with opportunities over the long haul.